Welcome to my channel, Balance Sheets Matter. In this video, I'm going to be doing an analysis on Salesforce CRM stock. So one of the first things that a lot of beginners and even this other people who act like experts out there have problems with analyzing stocks is when you get into software companies, they get scared away by these high P ratios and you think, my God, Salesforce, almost 140 P ratio. This must be massively, massively overvalued. But it really isn't. It's just because the accounting for a software company is quite different compared to a traditional company. So let's dive into the financials here. And I'm going to show you why that is and actually show you how we can value a stock like this correctly. So first thing we go to, we're looking at the revenue, great revenue growth going forward. It's growing at a good tick. It was growing mid-teens before. Now it's slowing to maybe 10%, a little bit more, but that's still pretty good. And they have this really high gross margin in the 70% range. But then the operating margin is quite low because of this really high selling and general admin expense. Well, the trick is you have to take more than 5 minutes looking at a stock and dive a little bit deeper, which really isn't actually diving deeper, and just look at where that expense is actually coming from their earnings. So I brought up their last earnings and I've already scrolled down to the area where it is, and you can see here the revenues. This is 3 months ending, this is 6 months ending, but you can see basically where it is in the operating expenses. It's all this marketing and sales. And in fact, when we're talking of our total operating expenses in 6 months being $10 billion, it's 6.8 billion is marketing and sales. So between these 6 months ending and that over 1 year, they actually spent $13 billion in marketing and sales. So the big difference for a software company like Salesforce is when they're wanting to grow their business, unlike a stock like Dollar General, which I just did a video on, and when they want to grow their business, they have to open a new store. Well, if Salesforce wants to get new customers, they just need to market more to attract them. And in the software, and especially software like they have, the customer base is very sticky. So this is the best way for them to grow their business and keep growing. And with software companies, they get to show this expense in their basically selling and general admin here, expensing 100% of it right away. Where in comparison, something like Dollar General, if we go down to the cash flow statement, it's going to be showing up in the purchase of plant, property, and equipment, and they're going to amortize it over 20, maybe 30 years. So something like Dollar General, when they're investing into their business to grow, we're not going to basically see that expense right away. It's going to be advertised over a long period of time, which is going to make them show a higher profit in the short term, where something like Salesforce, it's actually a big benefit. They get to expense it all right away because it lowers their profit, meaning they pay less taxes while reinvesting into that business and growing it. So the key thing you have to look at companies like this is not what their current net margins are. Let's go back up to the income statement, what their current net margins are, but you have to think where their net margins are going to grow in the future. And Salesforce is doing a really good job at reinvesting into their company and spending as much money as possible to not get taxed and focus on growing the business. And frankly, a business with a 74% operating margin, in my opinion, their net margin at the end of the day is probably at least going to end up in the mid-20s, maybe even the 30s. So I'm just going to do comparative analysis here. We're going to look at Google, for example, and let's go to their 30-year analysis here to take a look at their net margins. It's being a little bit slow, but there we go. And we can see Google gross margin lower, quite a bit lower than Salesforce's actually, and their net margin still in the mid-20s. So this idea of Salesforce achieving a mid-20s basically margin seems quite achievable. It might even be a lot higher than that. Let's take a look at Apple. Wait for this to load up here. And there we go. You can see their gross margin is actually even quite a bit lower in the 40s, and even they're able to show a mid to low 20s basically net margin. So that's looking really good. Let's also look at Adobe, because Adobe is another big software company, and I think their net margin's a little bit more comparable. And being kind of in the similar type of software realm, this might even be a better comp to actually look at compared to Google and Apple. So we can go here. We look at their gross margin here. They're higher. They're in the 80s, high 80s. and their net margin has been in the high 20s up to 40, mid 30s. It bounces around. They're kind of like reinvesting too. So Salesforce, it may be in the mid 20s, maybe be up to 30. We have to keep this in mind later in the analysis. So another big thing about Salesforce, I don't know why the data is not popping up here, but basically you can see from previous years and what's currently going forward, they pay very little interest expense. They actually have some interest income. With the higher rates they have now, they actually may be making a net gain off this. But this is really good, having companies in good financial positions, because if you have a lot of debt, a lot of interest, that can really bog your company down. And when things don't go well, that's how you go bankrupt. So we can see how well they're financially doing by looking at their balance sheet. So their current assets is $21 billion. That's a lot of cash and cash equivalents, marketable securities. You know, it got some accounts receivable, other current assets. Total assets are sitting at $92 billion. $48 billion of that is goodwill, which isn't really real, like a real tangible asset. It's just from acquisitions, so we need to keep this in mind. But their current liabilities, pretty much in line with their current assets, so the current ratio is fine. They're a company that's not going to have a problem anyways. But the real nice thing, their long-term liabilities is quite low. They have $8.4 billion in long-term debt, which is why they have a little bit of an interest expense, but probably for them the debt is so cheap, you might as well basically get it. And that leaves them with total equity of $58 billion. They did have $48 billion in goodwill, which leaves us only $10 billion in tangible equity, but it's nice to have a positive balance sheet. And $10 billion may seem like a lot, but their market cap's about 215, so this is going to factor hardly at all into basically the analysis. So now let's look at the cash flow, see what's happening with their business. So the big thing with Salesforce is the reason why their stock gets diluted is because they issue so much stock on stock-based compensation. Because all these tech companies, they're competing for talent. They have to offer their employees stock to keep them there and improve the business. And that's being basically the reason why they're being diluted. But it also helps add to their cash flow, because this is money that's going out that's not actually cash, it's just stock. And then you can see again the purchase of plant, property, and equipment, very, very low relatively. They do spotty acquisitions quite a bit because they're building this customer relationship management software portfolio. And the nice thing they've started doing is now they got this extra cash that they can't even reinvest into their sales and marketing. So now they're buying back shares. So just in the last 2 quarters, they've spent $4 billion buying back shares, which is really nice because in these last 2 quarters, this has been this whole time here. So it's been at, in my opinion, pretty attractive prices for their share buybacks. And this is going to actually over eclipse what they're basically putting out into the share-based, stock-based compensation. So going forward, we should see Salesforce's share count contracting. So I really like this use of capital. So let's now pop into the interactive chart to figure out how the valuation of the stock is and what's kind of a good price we can pay for it. So it's kind of useless looking at PE for something like this stock, but because we're looking at forecasting net margins and we have some comps already available, we're going to look at the price to sales ratio. So we can see right now they're trading at a 6.63. They traded a low of about 4, which is almost as low as they had during the great financial crisis in 2008, 2009. But normally during a normal market here, they're trading in the mid 5s, even up to the high 11s, and maybe a 10 here. So between a 6 to a 10 is probably a realistic net margin if they can meet these goals going forward. But let's comp that, compare it to some other companies, the ones we just did, Adobe, Google, and Apple, to see what price to sales ratios these companies trade at, so we can get a very accurate comparative analysis to see if this is a good value to buy the stock. So let's bring up Adobe here, throw up its price to sales. Remember, it probably is a little bit higher on the end of what Salesforce may do. But you can see here, it's back here, it was like trading a little bit lower, but once it's got up, it's been trading an 8 to an 18. So this is a little bit high, but Adobe does have a lot higher gross margins at 88%. So maybe it's justified. And let's compare this to Google here. Pop up the interactive chart. We're going to plot the price to sales ratio. And Google's been a very consistent company, and it's been trading on the low side. What does it trade down to? It sometimes trades down to this 4 or 5 range, and On the high side, it's trading up to a 7, maybe an 8. And they, remember, have lower gross margins, and their net margins are in the low 20s. So Salesforce, probably worst case scenario, they're going to be falling somewhere in this range, which means right now maybe they're fair value to a little bit undervalued with good growth going forward. But if they actually achieve higher net margins than Google, and because they're a little bit smaller of a company, somehow achieve higher growth, then, well, they're actually quite undervalued right now. Let's compare to Apple here. Bring up their interactive chart. Okay, and you can see Apple, once they kind of realized it was more of a software company, it's boosted their net margins up because they're doing all these subscriptions and this and that and the growth, and they're trading between a 5 to an 8 with much lower gross margins and in that low 20, basically, price to sales ratio, or most low 20s net margin. So we go back to Salesforce, and it seems like its historic PE ratio is actually probably a pretty realistic goal if they do manage to achieve, because we don't really know what the net margin is going to be until the future. So the market's going to price based on the growth, like the gross top margin there, and what the net margin could be in the future. So we could very well, again, be maintaining in this range of about 6 to 10, which I think is pretty realistic, putting basically Salesforce quite a bit on the undervalued side. So going back to my overall chart here, this is basically just like a trend analysis, and this kind of matches the overall fundamental trend of Salesforce, in my opinion, basically. And you can see here, compared to this midline, we're still undervalued, and it's probably somewhere around here, which is basically, the fair value. So even just getting back to fair value over the years, it looks quite easy over the next few years that Salesforce could double. I own a big position. I'm not looking at selling it for a while. If it got really high, up in the 500-600s pretty quick in the next couple of years, well, I'll probably sell some there. But other than that, I think this may just be a great buy and hold stock because they still have growth, they're reinvesting into their business, and they have great overall fundamentals. So I hope you enjoyed this analysis. I hope it provided a little bit more clarity of how to value growth and software stocks such as Salesforce, and be able to understand why a company with a high PE may actually be a very attractive value because they're basically reinvesting in their business like Salesforce. So remember to like, share, and subscribe, and stay tuned for my next videos because I'll be covering more of my top 25 stocks I basically have purchased and purchasing, and I think will outperform over the next year going in the future.